Hi there, well, welcome. And we're now in pre-show mode just for a couple of minutes before we get on with the main show. I might just put that on. Good to see so many people on, enjoying the pre-chat chat. And please like the post if you if you haven't liked it already. We've got 28 likes now, which is better than we were, but we had 646 playbacks. So there's a bit of a gap. Would appreciate your liking the post. It does make a difference, actually. It makes a difference to the way the YouTube algorithms work, and the more the post is liked, the more it gets spread, so it's worth it. And yeah, we'll talk about house prices a little bit in a second, Mr. Submariner. Don't believe prices are going to go down anytime soon. Maybe. In some cases, probably true. In others, they are already still falling. Very, very interesting. Flat tax, Otto. Yeah, interesting. There's going to be some interesting discussions about tax. We'll talk about what Biden said and what Janet Yellen said about lifting corporate taxes. Complete change of tune, change of direction. Pretty interesting. And it's very, very interesting. Very, very interesting what's going on. I tell you what, this show could easily go on for about 4 or 5 hours. I've got so much to talk about. I'm not going to, rest assured. It won't be that much length, but it will be, I think, quite packed with stuff. Anyway, great to see everybody on. Just might, play around with this for a second. Seeing as I've got the chat working, I think there you go. Hi, Hugh. Go 4226, Paul. Is that a postcode or what? We do have the postcode engine on. Remind me later if you want to do it. Prices, Tristan says, on a postcode basis. That's spot on. Exactly right. Granularity. Hi, Baxter Brisbane. Good to see you. And Otto says, yeah, the Biden proposal is very interesting. It is interesting. Complete change of tune. So it'll be interesting to see how that plays out. Have you seen the massive debt bubble over in China? Yes, I have been watching that. If you listen to Harry Dent, he says it's the biggest of them all. So even bigger than ours. Hi, Jeff. Good to see you. Cross-Stitch Shange says, the plaster on the wall of my property is going up this week. That sounds pretty exciting. It'll soon be finished. It's amazing. Managed that you can get all the resources you need. A lot of people can't. Hugh says, bring back the khaki shirt. Yeah, they're falling apart there. That's the problem. I decided I need to get some new ones, so hence the blue at the moment. But, we'll see. Okay, then I'm going to take the pre-show off. I'm going to take the chat off. I'm going to run the intro and then we'll get going properly. I'll see you in a second. Well, good evening and welcome to this live show on the 6th of April 2021. Martin North from Digital Finance Analytics here. Great to have you on board. Big show tonight. Lots to share with you in terms of the latest information. And not least, of course, the postcode level information that we've also got. Somebody was just saying in the pre-chat, you really have to go granular to really understand what's going on. And whilst there are definitely signs of positive momentum in some areas with regard to particularly house prices, not true in other areas, particularly for units and apartments. So it's a patchwork, of course, as I keep saying, you have to go granular. Anyway, before I get into that, we will do what I normally do, which is essentially just go through our quick introduction. And I guess I should just go through my normal discussions with the running order. So this is what we're going to be looking at. Start with this introduction, the house rules, about the models briefly, some key slides just to give you some context and background, questions and answers, and sign off. Looking to sign off about 9:30, give or take. I know there's a change in the hour. It feels very late at the moment, but we'll hang on hopefully until the end of the show. If I fall asleep, wake me up. Now, in terms of house rules, I always say this, but it's important that people actually do understand. I don't offer financial advice. I'm not qualified to, don't know your individual circumstances. I'm talking in general terms. I'm talking based just on my data. So please don't take it as financial advice. If you need financial advice, then go talk to a financial advisor. Please do play nice in the chat room. No racial slurs. We do moderate the stream. And I do encourage all of the cross chat and all of the interplay, but please keep it clean. And this is as at the 6th of April 2021, so if you're watching this in replay, you'll know whether we were right, whether we were wrong, or what has happened since then. Use that Walk the World if you want to get my attention. There's a lot of stuff going on in the chat, but that's the best way to make sure that your question comes to the top. But if you also want to ensure it comes to the top, then you can also use Super Chat. Super Chat's enabled, and you can also do that in terms of making a contribution to the show, making sure that your chat gets to the top. So both of those are quite useful things, I think, in terms of what you can do with Super Chat. Now, in terms of the core models, I always do this just because there will be people who haven't seen this before. Many of you, of course, will be able to do it in your sleep, but let me just quickly explain. We survey households. Those surveys run continually, and the data is up from last Tuesday. So in other words, just over a week ago, because it didn't get updated because of Easter. And we pull information from all sorts of sources. Those allow us then to make some estimations as to what may be happening. We slice and dice the data through different dimensions, and that allows us then to think about what our scenarios might look like. We've updated our scenarios once again, and also, of course, think about what home prices are doing. We take the mortgage stress data, the trajectory data, the buying and selling intentions, the migration data, the economic data, put it through the core model, put it through the scenarios, and that allows us then to formulate a view of price movements, potentially ahead over the next 2 or 3 years based on regions, states, and all Australia level. Now, in terms of the main news today, the RBA held again. No surprise there. There were a lot of people who were expecting just that. And there was very little new, actually, in the minutes this time. But there were a few things that I want to highlight. And the first one is they said that maintain current policy settings. Yeah. Recovery is uneven. Yeah, they said that before. Inflation expectations have been lifted from near record lows and is now closer to central bank targets. Well, we sort of knew that. Recovery is stronger than expected, and he quoted the latest figures with regards to unemployment and the GDP. Of course, we know that. They said wages and price pressures are subdued and expected to remain so for some years. So no expectation of pay rises anytime soon. Also, they mentioned housing prices, rising housing prices, low interest rates, and the bank will be monitoring trends in housing borrowing carefully, and it's important that lending standards are maintained. That's the first time that I think I've directly seen them refer to lending standards, which is interesting. So they are getting a little bit twitchy on that. I wouldn't be surprised to see a bit more of that later. Further bond purchases will be required and will be made. Of course, we're all thinking they're going to do a lot more. The total balance sheet at the Reserve Bank is now 215 billion, remarkably big and continuing to grow. And by the way, the term funding facility, which is the very cheap money to the banks, 95 billion drawn down, another 95 billion available. So that can continue for a bit longer. I think it's due to end in June. And basically they said, we'll just keep on doing what we're doing, and don't expect conditions to be changed until 2024 at the earliest. So really, there is very little there that has changed the tune, other than just, I think, focusing specifically on the lending stuff. And I am seeing, interestingly, significant changes with regards to lending standards. So if you look at the average first-time buyer loan today, it's about 15 to 18% bigger than it was a year ago. 15 to 18%, right? And that's while incomes have gone nowhere, prices have gone up, of course. And so there is plenty of evidence, if you want to find it, for lending standards getting looser already. And you may recall that I previously showed you this chart, which is actually the share of high loan-to-value loans. This is from APRA's most recent data, and it's basically spiked So we're seeing higher loan-to-value ratios. We're seeing high LTIs as well, loan-to-income ratios, and also more loans with interest only. So all of that is signalling the same thing. I think lending standards are weakening, and I think that unfortunately the APRA, who's not interested in the house price movements at all, and the RBA, who doesn't really know what they're talking about with regard to this, in my view, will be caught again quite short because of it. We'll see, I guess, but that will be my view. Now, when it comes to other information, there was a very interesting article today by Shane Wright in the SMH. The central bank under fire, has the RBA failed Australians? And he cited the plaque that actually the Reserve Bank has, literally as you go into the Reserve Bank, it's about the economic prosperity and welfare of the people of Australia. And basically the argument is that maybe the RBA is not keeping up with its mandate. The bank is now facing rare criticisms by leading economists, former treasurers and monetary policy experts who believe the bank failed the country and hundreds of thousands of people by holding interest rates too high for too long ahead of the pandemic. And some experts even believe the bank governor, Philip Lowe, should resign and the RBA board should be overhauled. Very interesting. There's quite a long article. I recommend you read it if you've not seen it. The fact of the matter is there is questions arising about what the Reserve Bank is up to. Do they really know what they're doing? They've undershot on so many of their expectations, so many of their estimations. And of course now they're doing some rather weird things with regard to quantitative easing. And I guess the question that people are asking is, do they really know what they're doing, or are they just hoping that things will somehow magically turn out? And by the way, will the inflation just magically appear, and will that then effectively get everybody out of jail? Well, we'll see. I think there are some big questions ahead, but that's quite an interesting one. Now, another interesting piece of data that came out today was this. This is from the US, and this is the US rate rises. Now, this is from Barclays PLC's analysis, and basically shows that the market is betting that the central bank will be forced to tighten well before it wants to. So essentially in 22, 23, 24, 25, rates will be a lot higher than the Fed wants, a lot higher than the dot plots that the Fed issues. Now, if that's true, that's another leading indicator of potential trouble ahead, because of course even small interest rate rises from this point will create huge pressure on many borrowers, both corporate and individual. And that's one of the things I've been starting to watch more closely now, because I do believe that we're going to see more of that ahead. Interestingly, of course, Biden, as we mentioned earlier on, also has been talking about corporate taxes and basically saying we should put corporate taxes up 28%. And it's interesting that the discussion now is that, corporate tax is not working. A lot of the big corporations are not paying their due, as Biden said. And Janet Yellen has said we need to actually work collectively around the world to raise corporate taxes. Pretty remarkable turn. I actually agree. I think it's probably what's required. I think the corporate taxation take has dropped dramatically. There are many that are able to fiddle the books and essentially get away with almost paying no tax. And in fact, Biden, when he was talking about this, said, if you look at some of the big US firms, they pay no tax at all. That is not acceptable. And of course, he needs the tax take to be able to help to repay the massive debt that's been created, the 1.9 trillion already stimulus, the 2 trillion that he's talking about, and probably more. And I think it's going to be an interesting discussion, because if in fact we are now moving back towards a higher tax environment for corporates rather than actually a race to the bottom, that could change the dynamics quite quickly and quite significantly. So I think it's a very important comment. Now, in terms of important comments, the other interesting one here was from the Kook, who actually made the point that the 819 billion bomb, that's the amount of debt we've got. Publicly speaking, it's actually over $1 trillion really, and he was questioning how that's going to get paid back later. He says it's not an immediate issue, but it will be later. I have a feeling that this debt burden that the Australian economy is now dealing with is really going to be a real trouble something later on. And remember that the Treasury projections are that the debt could be to over 1 trillion. It could be up towards 1.5 trillion. That's huge. And of course, if rates do go up, boy, that's going to cost a lot, and that's a real problem. Now, in terms of the credit data, I went through this in some detail the other day, but just quickly, it's interesting that there is some credit growth, not massive, but a little bit. Occupation lending was up 5.91% over the last month. Sorry, that's annualized, so that's 12 months. Overall housing 3.81. Investment just a very slight rise over 12 months. The personal credit still well down, although just moving slightly higher compared with its absolute low, and business borrowing down. This is not a sign of an economy that's doing well, and this is a sign of an economy that is being force-fed housing finance, in my view, but it doesn't necessarily take us to where we need to get to, I think, economically speaking. Now, there's another interesting article from The Economist, and they were making the point that house prices are actually rising, not just in Australia, but in pretty much all advanced Western economies, and they basically trace it directly back to all the quantitative easing. So essentially all the QE is driving stock prices up, it's driving home prices up, and they make the point that that growth is not really real growth in terms of creating real value. It's really just a response to the quantitative easing. And of course, I've said for some time, the trouble is with this quantitative easing, it's flowing into particular assets. It's not necessarily flowing yet into the real economy. And therefore, we might be in the situation where, whilst on one hand, we've got some asset classes rising in value, we've actually got deflation working the other way. And as rates go lower, of course, the deflationary pressures get larger. So it's going to be interesting to see how that plays out ahead. Now, let's see what else we've got here. Interestingly, of course, that the fixed rates are disappearing, particularly the long-term rates, the 4-year rates in particular. And I think that we're going to see more and more of the banks not offering the longer-term rates ahead because, of course, the fund rates are rising. And on that point, we're going to see, I think, probably a focus on short-term rates. There is quite clearly in my mind now a risk that we will see out of cycle rate rises for mortgages ahead of what the Reserve Bank might do, partly because the TFF, partly because of the yield curve movements that are happening, and partly because the margin compression that the banks are benefiting from at the moment with very low TFF will reverse in due course. They've got 3 years to pay the TFF back, but nevertheless they'll have to start raising funds elsewhere. I think those factors together may actually lead us to quite an interesting position where we'll start seeing some rates rise. And of course, even small rates would actually have a significant impact. And this is actually from CanStar, who made the point that 2 in 5 or 40% of other Australians think home loan interest rates will rise somewhere between now and the end of 2022. Top 3 reasons for speculation of rising interest rates include the economy will recover by then, 42%, inflation is expected to rise 39%, and in order to slow down property growth. So I'm going to interview Steve from CanStar tomorrow, and I'll talk more about that research in a subsequent show. But I think it's very significant that there is now more talk about this. And all I'd say, folks, is if you are going to commit yourself to a mortgage at the moment, you should definitely ask yourself what would happen if rates rose, a couple of percent. Could you still cope or not? Because it is a big deal, I think. And on that same vein, it's interesting that Tim from CoreLogic wrote today that rates remain on hold, but tighter credit conditions loom. So he's arguing that the rates might not go up, but nevertheless there might be some tighter conditions with regard to lending, some sort of new round of macroprudential policies. I think that certainly could be the case. I refer to what happened in New Zealand. I've spoken about that a few times, where they've effectively given the Reserve Bank of New Zealand a responsibility for house prices now, and also they've put a dampener on investment properties and reduced some of the loan-to-income and loan-to-value ratios that banks can operate under to try and calm the housing sector. No sign of that in Australia in the short term, but it may come later. But nevertheless, the fact of the matter is that unless those interventions occur, we will probably see house prices in some areas, particularly for fixed freestanding homes, continuing to rise. Probably less so for apartments, as we've discussed before. But it's a pretty tricky situation, and I'm not sure whether the Reserve Bank is really fully alert or not to all these issues. Now, in terms of movement, there's an interesting chart from SQM that just really underscores the fact that if you look carefully, sure, houses are actually up in quite a few of the centres. This is based on asking prices. But if you look at units are continuing to grind lower. So, for example, in Sydney, 12 months change for units down 5.4%, which is a bit of a concern. If you look over the last rolling month, down 0.8 or 0.7 in Melbourne, down in Perth still, down in Hobart. Units, that's houses down in Hobart. So there's not a complete story here that everything is going up. Different things are going up at different rates, and it goes back to my fundamental position that you've got to go granular. You've got to really understand which types of property are moving in what direction, and you have to go really very granular to really understand what is going on. Now, thanks to Cookie Boy for this one. This is just the latest listings. Total listings are actually down. Actually, rental listings are a bit higher at the moment. But interestingly, there's about 38,000 or so under sort of marked as sold, or to be sold, as it were, in terms of the processes, the offers there, or what have you. So compared with normal, this is quite a lot lower than normal. So we are seeing lower stock levels. That's one of the reasons why prices are moving a little higher. Now, if we come to mortgage stress, it's still elevated. In fact, it was dropped just a little bit from last month. So this is based on my latest data to the end of March. So it was 41.8% last month, 41.1% this month, so down very slightly. And interestingly also, the Reserve Bank revised the household debt ratios up to 180.4. So they had previously said that the ratios were down about 179, but no, it's going up again. So we're seeing the debt ratios. And remember that the debt ratios are not stating it correctly, because they are basically taking the total debt by the total households, but only 1/3 of households actually borrow. So you need to multiply the debt ratio by 3 to get anything like the true ratio, which means that the true ratio is 5 to 6 times on average. And we're seeing some new borrowers at 8, 9 and 10 times debt to income. That is huge. That's highly risky. And once again, more evidence of the fact that we are seeing a lot of poor lending practice going on at the moment. Now, briefly on the old stress data, you can see there that mortgage stress is highest in a number of the states. Victoria at 45, Tasmania at 54, still leading the way, and the NT, the highest proportion of households in mortgage stress. And just to re-emphasise, stress, of course, is cash flow here. This is how's the money coming in, how's the money going out, are they able to cover the mortgage repayments and everything else? When they're not, when they can't, they're classified as stressed. Rental stress, highest in New South Wales, and also quite high in Victoria. The average across Australia is 35%. That's because, of course, New South Wales has a very large proportion of rental properties. And in terms of investor stress, well, we're seeing the New South Wales situation and the ACT situation continuing to be troublesome. Some of the others less so, 26% overall. But that still transfers to 843,000 stressed investors. And then financial stress, which is the aggregate of all of those, taking account of all households, 43.9% of households in the ACT registered as financially stressed overall, 44% in New South Wales and 39.5% in Victoria. Overall, Australia, 37.7%. And, that turns out to be more than 4 million households out of 9.7 million that actually have struggled with some aspect of their finances. And so that's a big deal in terms of what's going on at the moment. Now, it's also just worth noting, of course, there's going to be much more discussion about affordable housing. Housing affordability continues to deteriorate. This came out from Domain. 173,000 homes affordable to low-income earners required, I think that's an understatement. We have to think differently about this if we're going to actually deal with the issue of unaffordable housing. Just offering bribes for people to buy into the housing sector at this stage isn't working. I can tell you that. A lot of those first-time buyers who bought on the government scheme are already registering stress, so that's not working very well. We need a different strategy. I hope it becomes an election issue whenever the election is going to be run, but that probably won't happen now till next year. Now, in terms of by segment, again, this is the latest data. So it's interesting, once again, that young growing families, of course, are right up there at 57.8%. That's quite a lot of households. So you can see there 240,000 in mortgage stress. Young affluents also there as well. That's because they are able to commit themselves quite considerably. It's a relatively small proportion, 31,000, because it's a small segment. And then we've got people in the exclusive professional group because of the leverage they've got and the multiple properties and the interest-only loans that they've got. And then we've got the battling urban, the people on the outskirts of town in the high development growth corridors. Mortgage stress there, 61%. Disadvantaged fringe, 62%. Young growing families, 74%. It's a big deal. And you can see there that financial stress, rental stress, and investor stress is also represented quite widely across these segments. So, as I keep saying to everybody, you can't just take this as an aggregate or one particular segment or one particular locale. It's a very much more complex picture than it might first appear. And just quickly then, if I take the conversation on from there, interestingly, landlords are wasting no time in issuing notices of vacate after eviction moratorium ends. We're seeing a lot of people who have been clinging on with their fingernails, particularly those in rental stress, being kicked out. We're going to see a lot more of that, and I think the number of people who will be desperately trying to find alternative rental accommodation at a time when rents are also going up in some areas, particularly in the West, it's a big deal. I'll also make the point that there was an article that came out today about at least 2.6 million people face poverty when COVID payments end and rental stress soars. Well, exactly. So, whatever the real number is, it's a big number, and that's this K-shaped recovery that we keep talking about. So whilst we've got some proportion of the population doing pretty well and, they're in full-time work and they're borrowing big, you've got this other group, which is a big group, and unfortunately they're going to get caught up in the difficulty. And I fear that the difficulty is going to get worse ahead rather than easing anytime soon. I expect unemployment to rise. I expect rental distress continue to rise for some time. And unfortunately, I don't see an easy way out. Now, in terms of the information, just quickly, this is the stacked list, starting with those mortgage stress. So the biggest number are in Narre Warren, in Victoria, Chipping Norton, New South Wales, and then places like Hocking and Tapping in Western Australia. And you can see there that 85% of people in Narre Warren, that's a big growth corridor down in Victoria, are in mortgage difficulty. 70% of those with a mortgage in Chipping Norton, and that includes places including, of course, Warwick Farm, Liverpool, and places like that. And you can see there that Berwick and Hackaway, 86% in Victoria. Pakenham, another high-growth area, 82%, and so it goes on. So you can see that there is a pretty consistent story. Also, places like Ballarat are also registering there. Now, if we then look and the rental stress, it's a bit of a similar situation. So we've got, again, Liverpool right up there with rental stress, 51% of borrowing of renting households in rental stress. Bidwell, which includes Lethbridge Park and places like that, 71%. Greystanes in New South Wales and even West Gosford up in the Central Coast, again, registering quite strongly. Blacktown as well. So you can see there that the New South Wales leaderboard at the top. Then we go to South Yarra, Toowoomba, and on it goes. New South Wales, Surrey Hills, a higher, more affluent group, you might say, but also struggling. Port Macquarie, Wollongong, then to Victoria, Cranbourne, and so it goes on. It is a patchwork. And here is the stressed investors. So St Kilda actually is leaderboard now at 74.54% of investors in the postcode and 4,000 stressed. Then we go to Greystanes in New South Wales, and then we go to Queensland, DY, another Queensland postcode, the two Meadow Springs and Mandurah in WA. I'm afraid Mandurah is still grinding through. Surrey Hills, Darlinghurst, and so it goes on. So, you can begin to see a bit of a pattern with the postcodes. And then the final one is overall financial stress. So Chipping Norton, Liverpool, that area, Warwick Farm, has the highest concentration of financial stress in the country. Then Toowoomba, 41% of households in Toowoomba are financially stressed. Then we go to Cranbourne in Victoria, high growth corridor, 52.9%. And then we go to Lethbridge Park and Bidwell, those places like that. And then we go to Point Cook, Derrimut, over in the western side of Melbourne. And so it goes on. Narre Warren, of course, is there at 81.5%. And in fact, Narre Warren and the area around Lethbridge Park at 82 are the highest proportion. So this is a very significant issue, and it's one which I think will pay pain and create pain for a lot of people in the weeks and months ahead. Now, in terms of another way of looking at that, I do have my stress mapping, and the stress mapping, of course, this time I've done it not by percentage, but I've done it by the number. And so we'll just start with Sydney. So this is the distribution. The sort of the orangey and reddy are the most highest counts of those in mortgage stress. So you can see there, as I pull out from Sydney, you can see the obvious ones: Campbelltown, Liverpool, Blacktown, all around there. So you can see the bands there. There are a small number of counts closer in, but you can see where the pain points really are. And interestingly, if we do a bit of a search, let's go to 4,000 and look at Brisbane. And so we home in at 4,000 and then we can pull out. And a bit of a similar story insofar that there are a few hotspots. It's not as bad as Sydney, but nevertheless, as you pull out, you begin to see some areas where there's a little bit of concern, like around Ipswich down here, for example. And as you pull out further, you can see further signs of stress as we go through the Lockyer Valley and even out as far as Toowoomba. It's over there, Toowoomba. I'll move that across a bit. A bit around the Gold Coast, a little bit north, but it's not as significant as what we've seen in Sydney, but we've got these pockets. And Toowoomba, of course, as I showed you, was right up there. Now, if we go to 5,000, I'll come back to Victoria in a second. So this is Adelaide, and again showing you the number of households, measuring in terms of mortgage stress. And you can see there that we begin to see some interesting footprints once again. Not too bad, but then we got to Salisbury, and it's a little bit of a concern. And so it goes on. Now let's do 3,000, because Victoria and Melbourne really shows it quite well. I showed you those postcodes in written form, but look at it now in graphical form. And once again, as you pull out, you see that there are starting to appear over towards the west in the Wyndham area. The stress levels are much higher. If you look, then we've got down here, sort of in the Narre area and places like that. They've got north of Melbourne as well. And as you pull out, you begin to see places like Ballarat. So you can see that there are hot spots, right? And the thing about this is it highlights perhaps areas where prices will be under more pressure simply because of the greater degrees of stress. Then we might just do 6,000. Bit of Perth. Now, of course, Tony will say Perth's doing very, very well, and it sort of is. But nevertheless, as you go out, you can see Wanneroo, significant hotspot there. and there's a few others as well, up and down the coast basically, close to Perth itself, doing quite a lot better, particularly now with some of the economic variations that are going there. But nevertheless, there are some pain points in Perth. And then I'll just do 7,000 Hobart so that we don't miss out the major areas. And again, you can see that there's a little bit of pain and stress, but nowhere near as much there as compared with some of the other places. So again, it shows you the patchwork quilt effect of different types of property, different types of postcodes, different types of people in different locations. So that's a quick whiz down around the maps. Just go back to there. Okay, so that's the stress mapping. Now, just to finish off this bit of introduction, UBS is saying 15% year on year coming, and suggests that the regulatory forces will be later. They're unlikely to implement macroprudential tightening in the near term, possibly later. We now see upside risk to prices 15% year over year unless regulators step in. And then they've said that whilst the home builder and other fiscal stimulus measures march, we'll see some moderation of demand. The repeal of the responsible lending laws could counter that. Now, in our scenarios, remember that the scenarios are merely just a way of looking at the way that things might be. It's not a prediction. It's just to have a talking point. We have updated our scenarios. And the first thing to underscore is that now the RBA baseline has been changed, the unemployment rate's dropped, the mortgage stress has dropped, the losses are down, the prices are higher, still giving it a 10% weighting. But then I've given the next one down, which is effectively the vaccine rollout works, unemployment goes up, then comes down again, significant rise in home prices still possible, and 50% probability. So 60% now of significant price rises over the next 2 or 3 years. There is also, of course, the risk of a longer-term crunch, so we get more of the local outbreaks, and if that happens, then that will be quite different. I give that a 30% weighting at the moment based on all the data that I'm seeing, but we'll probably continue to detune that over the next little while if, in fact, the sort of variants of the virus are kept under control. I'm interested to see what happens when they open the bubble to New Zealand, whether that creates a bigger issue. And then just a small proportion looking at multi-wave disruption. So in other words, if we had something like Europe's got at the moment, that would be a completely different story. Or indeed, if we had a global uncontrolled pandemic, it's still there on the horizon, but unlikely. So I'm really now in this camp that says, you know, we could see prices 25% higher over the next 2 to 3 years. On average, it varies by type of property and location. Units, not so much. Houses, standalone houses, more so. So that's a pretty strong change from where I was 9 months ago when the unemployment rate was expected to be 10% plus, where effectively the stress level was a lot higher and where the losses were higher too. So I guess what I'm saying in conclusion to my scenarios is don't expect a crash of house prices anytime soon. Expect probably a drift up, and in some cases a considerably larger rise because rates are so low and the banks are lending freely. Could change if rates go up, could change if macroprudential is brought in, or if indeed if the virus comes back. So that's essentially where I see things sitting at the moment. And that's pretty much what I'm going to say. Now, let me then move on to talk about the Postcode Tool and the fact that we've now got this pretty much complete. And in fact, those people on Patreon who've signed up for the data set, the stress data each month, will shortly be receiving an email, and that email will include login details to the Digital Finance Analytics member zone. And in there, you'll be able to access all of the stress information, and as well as the current stress, some historical information as well. And I may well show you a little bit more of that as we go through the Q&A, but that's going to be launched later this week. So if you're signed up for the US $50 Patreon level, you'll be the first to try the beta, and then we'll roll it out more broadly. And we've got some quite interesting plans ahead. I'm planning to create a bit more of a community feel within the member zone. And there'll be other information and some other material coming soon. So that's all about to be launched. Watch this space for more announcements because it's going to be pretty exciting. Okay, and with that, I think I had just two more quick things to highlight. Firstly, you may have heard me on Radio National this morning talking on house prices. If you didn't, it's worth listening to. The question that I was discussing was, will house prices go down? And it was a pretty interesting, I think, discussion. So I may make that available on my website in the next few days, but it's on RN Replay at the moment with Hamish. And then the Q&A. So we're now going to go into the formal Q&A. So let me come back to the main screen and let me just see what's around there in terms of, I'm going to go back up and just see what people have been saying. James, thank you very much for that. I really appreciate the coffee. Wonder which part of the country you're buying coffee in. It's quite an interesting question, isn't it? Oh dear, oh dear. And okay, AI says, what is the tipping point of mortgage stress analytics? The tipping point, so what I'm doing here is I'm looking at cash flow, so money in, money out. So I'm basically saying, let's understand household budgets. Let's understand what money is coming in. That's obviously after tax and everything else. What money is going out, and is there enough to cover all of those costs, including the mortgage or the rent or whatever it is. So that's the way I do it. And basically, if they are neutral or below, then they're in stress. In fact, in my deep analysis, I go into mortgage stress at two levels, mild and severe. Severe means they're deeply underwater. And traditionally, what happens in my analysis is that once people get into that sort of cash flow bind, they ultimately end up having to try and refinance or find some way to get out, or indeed have to sell, but it can take some time. But so that's the way we do it. It's based on cash flow. And there's a post on the blog which essentially explains in more detail the way that we actually go about thinking about it. Tony Locantro, we've peaked the peak of the Telegraph proud purchaser index. Without another black swan event to halt the negative trajectory, CoreLogic Index to resume its downward spiral, housing realists back in charge. Love your work, Martin. Thank you, Tony. I appreciate that, and thank you very much for once again supporting what we do. It is appreciated, and it is an interesting time, right? I'm still of the view that we're not out of the woods, and as you know, and I've discussed with you before, Tony, we are going to see this grind through for some time. It will be very, very interesting to see what happens later. Now, what else have we got here? Yeah, let's go back there. Cross-stitch Ann makes a really interesting point. Compare financial stress suburbs with crime mats. I've done that, and there are some very significant correlations. So it's clear to me that there is a social consequence set that flows from the fact that people are struggling. And crime and social violence are the two things that we see quite often in those situations. So it is really quite concerning. And unfortunately, if you look at even things like marriage breakups and those things, there's a correlation there too. Unfortunately, it's all connected. And those social consequences are the ones that people, I think, don't generally really relate to and understand, but they can be quite profound. And the other point to make is there, of course, that when people get in financial difficulty, it often leads to relationship breakdown and more arguments and those sorts of things. And, there are social consequences, which, of course, are very, very concerning. I spoke to Eddie Hobbs a couple of years ago, the guy over in Ireland, who was talking about this post the global financial crisis and said, the biggest issue that we had post the global financial crisis wasn't the financial mess. It was the social mess that was created. It was all of those people who were without jobs, all of those people who were socially caught, the violence, all those things, and even crime. So I think that Eddie Hobbs's view is dead right, and I think we need to watch those broader metrics too. See what else we have. Jessica says, I feel like this housing market will never stop going up. Depends where you look, Jessica. So there are definitely areas, particularly standalone houses, where prices are still rising and will continue to rise. And quite often they are people being bought by people who either want a freestanding home with a reasonable plot or are buying to subdivide. Subdivision is a huge driver at the moment of a lot of the transactions that are currently in play. Of course, the planning laws have basically allowed that. So that part of the market is definitely rising. I'd also make the point that we're seeing quite a lot of rises on the new build side as well, because thanks to the government stimulus, new prices rose by the amount of the stimulus on average, or slightly more, and that's put an increased price on new builds. And of course, the thing about new builds is we're seeing now that some of those will get completed a lot later because they can't get the resources, the builders, they can't get the timber and the other materials to build. So it's going to be a real mess down the track. High-rise units still going sideways, still going down. And if you look in the number of areas in and around Sydney, you'll see that prices are actually lower and continuing to fall. And we're still seeing more high-rise developments where the flammable cladding and the cracks are continuing. So it certainly is going to be a significant issue. And probably investors still struggling there. Rental occupancy is very low. And in some cases, people are having to give up and take a smaller rent if they actually want somebody to rent. Until such time as students come back and international borders fully open, and that's going to be some time away. Clearly it's going to be longer than we were thinking because the vaccine rollout is much slower, and that basically means that the borders will stay more closed for longer. Now, Otto makes a really interesting point too. I think you're right, this latest housing boom was engineered mostly through propaganda and wishful thinking without anything underpinning it. It will fizzle and reverse. Yeah, there is a lot of hype about, there is a lot of rubbish being spoken. There's a lot of underquoting, of course, as we've discussed on a number of occasions. And the problem, of course, is that the high-level metrics that are being quoted without any real firm basis are often frankly, without a lot of underpinnings. And so people are, in some cases, prepared to pay more. And in some cases, there are stories of people turning up at auctions and seeing the price go 300,000 over the asking reserve price, or whatever you want to call it. How much of that's underquoting? How much of that is just enthusiasm? Who knows? But there are others where things are not as good. I've attended a few auctions where nothing has happened, even in the last few weeks. So it's not universal. But you're right, there's a lot of fictitious stuff going on here. And remember, of course, the Reserve Bank and the government is trying to talk everything up. They want the wealth effect. The wealth effect is a critical thing to understand, because essentially what they're thinking is if people have the feeling that things is better because prices are going up, then they're going to spend more. If they spend more, then it's going to actually impact the GDP, and that's good. That's the theory. So effectively, the housing sector and the growth in debt is being used to try and underpin GDP performance rather than investing in real things that we should have been investing in to create the real economy. Unfortunately, we haven't done that, and we will, I think, find it very difficult to sustain this ahead. And by the way, as I said earlier on, business investment is still very low. So, in fact, a lot of businesses are not able and not willing to invest in their businesses at the moment. So, effectively, we're a one-trick pony. We're an economy fundamentally being driven by higher home prices and the promise of more price growth ahead. I fear, though, some people might well be disappointed. So, Otto, I think you make a very good point. Master Single makes another interesting point as well, and that is that affordable housing is sorely needed in the next 10, 20 years. Yeah, absolutely. We have really stuffed up here with, frankly, outsourcing housing to the private sector and just assuming that the private sector will do the right thing. It's not working. If you look at the property investing portfolio of many people, they've got quite a few high-rise apartments under their belt quite often. Quite a few of them were, attracting particular types of tenants, but those aren't necessarily affordable houses. And certainly, if you want to buy, something that is not too unaffordable. Very little of that around. Very little public housing, very little public-private partnerships to try and actually deal with housing affordability. The only thing that the government's come up with is basically raise your super, tick, borrow from the bank of mum and dad, tick, and then take those grants, be it the first homeowner grants or the home builder grants, to effectively go build something. That is not solving housing inaffordability. And unfortunately, I see very little intent nor indeed interest in solving it. We have to, though, because the long-term consequences are dramatic and negative. And by the way, that means a lot of people will never own a property. They will always be renting. And one of the big things to understand is, as you move into retirement, if you're still renting and you're still having to rent in retirement, you are financially significantly disadvantaged relative to those owning property. And so that's one of the other factors that people need to take into account as they sort of go through their life journey. Renting might be good for a period of time, but if it becomes the default mode right the way through life, unless you save carefully separately from property, you need to be intentional about it. You can end up significantly disadvantaged. But I agree, if housing affordability is a big deal. Okay, what else have we got? Jessica made the point. Well, do what most millennials are doing and buying tech and crypto. Well, maybe. Crypto, of course, is unpredictable. Might go up, might go down, might disappear to zero, might go to infinity. Who knows? High risk. And if you buy in the tech sector, well, look at Afterpay. Afterpay's dropped way back from where it was previously. It's not necessarily certain. So there are risks in those alternative strategies. And I have a feeling that many people don't actually really understand precisely what they're getting into. Now, Vanessa asked me to define young affluent. So young affluents, these are individuals or maybe newly formed families that are essentially able to use their combined joint quite large incomes to essentially go buy in the property sector, and particularly. So they might well live in places like Bondi, for example, in and around Sydney. They tend often to live closer into the CBDs rather than actually being right out on the urban fringe. They'll quite often be professionals or close to being professionals, but the critical thing is they have high incomes relative to normal households. And they tend to then buy big. They tend to do a lot of investment properties. They tend to actually think they're very smart and, very sophisticated in their investment strategies. They often do cross leverage. So in other words, use the equity from one property to buy the next, to buy the next, to buy the next. And they'll quite often do things like rent investing as well. That is a typical young affluent. So typical age group up to about 30, 35. And as I say, either singles or indeed, in some cases, newly formed families. But they'll tend not to have many kids. They'll tend to be perhaps living in apartments rather than houses. What else have we got? Yeah, Master Single makes another range. Australian higher education sector is already collapsing as we speak due to years of poor federal education policies. Absolutely right. And, we have been reliant on overseas students. The education standards have been dropping. My wife worked in the education sector for many, many years as a professor and other roles too. But as a professor, she always said she was amazed just how devalued the degrees were, how much people were effectively being able to get degrees with less capability. And of course, a lot of those were foreign students that essentially primed the pumps, primed the cash flows of the universities. The whole university sector is very much up against it. Of course, the university sector didn't also get JobKeeper. So there are a lot of job losses in the education sector, and it's going to continue. I think the borders won't open for some time, and of course people will be thinking about an education plan for not just 1 year, but for 3 or 4 years. And that means that people who haven't started this year or last year, they won't be there for the next 2, 3, 4 years either. So basically what it means is that this is going to be a real long-term significant issue. It's going to hit our education sector significantly. Of course, the universities have been calling out for government support. Government doesn't want to do that. It also means, of course, that some of the R&D work isn't going ahead, and some of the work that would be very valuable for us into the future isn't actually going ahead. So it really does have a big knock-on effect. I think we haven't seen the worst of it yet. John Don said, let's keep Bitcoin and cryptocurrency out of the conversation. Now that's an actual Ponzi scheme. Yep, I'll leave that as a comment. Okay. Mark made the point about Bergen Hathaway. Yeah, you just look carefully. There are areas where it's being subdivided and chopped up. There are still some acreage properties there too, but look at the margins, right? You'll see in a lot of these areas we're seeing a lot of new subdivisions happening, and those subdivisions are attracting completely different types of people. And by the way, quite a few of them would actually sit in our segments that would actually be first-generation arrivals in Australia. So that's something else to bear in mind there in terms of the types of people who would be buying. Okay, what else have we got? Okay, so this is from Tiger 21, 4101 houses versus unit stress. Right, so let me just go here, and I will then load up my in there. Okay, so if I go to here, this is actually the member zone I mentioned earlier on, and within that you will see, oops, you will see here, hopefully. So it was 4101. I'm going to put that in my model, 4101. Look it up. Okay. Now I might make it a bit bigger just so that it's easier to see. There you go. And I'm going to take the chat off. Okay. So this is 4101. 4101. Make sure I got the right one. Yep. Okay. So 11,000 households, 2,000 borrowing, 7,800 renting, 5,900 properties for rent. Numbers of rental properties, quite high, 4,400. Financial stress metrics, 68%. This is South Brisbane, West End and Highgate Hill in Brisbane. Mild stress, 1,000, which is around 50% of those borrowing. Risk of defaults, 3%, that's quite low. Rental stress, 3,827, 49%. And look at this, property investors, 70% are stressed, 368 severely stressed. So this is an interesting conundrum where effectively the investor sector is struggling. Here are the unit and price projections. So you can see there that in my bullish case, I'm basically suggesting over 3 years prices for houses could be up 14%. I'm thinking units could be best case about 19%. And you can see there that they're both accelerating away. That's on the assumption that the virus gets under control. In our bullish case, that essentially the borders get reopened next year, tourism comes back, the migration increases, the rates stay low. We don't do quantitative, we do more quantitative easing. We don't do the tightening of lending standards, and so everybody goes buy, and that's the result. So there you go. That's 4101. Whoops! For some reason, it's just linked on me. Not sure why that's doing that. I might just come back to there in the meantime. So there you go. So depending on whether there are other questions, we might come back to the tool. As I said, the tool will be available for those with the Patreon subscription. I will be sending out as well the complete data set under the Patreon program for those with data effectively from up to the end of March, but then you'll be able to access the online version. And one of the things about the online version, which is quite interesting, is that the stress data is also now including some historical information on mortgage stress. So if I just go back to this for a second, right, you can see here that we've got the mortgage stress over the last few months showing by investor stress, rental stress, financial stress, and mortgage stress. So it's trying to provide some extra functionality, and there'll be more functionality coming later as well. So hopefully this will make quite a good tool to start with, and then we'll be adding more functionality to it and basically creating more of a community around it, hopefully, as we go. But it's all going to be based around sharing that postcode level granular information so that people can actually service themselves, get information themselves, make comparisons over time. And there will be various comparison tools that allows you to compare different types of property in different locations. We can roll it up as well to aggregate levels, including things like state, region, national Australia, and you can make comparisons between states. All of that will be available in the tool set. So those of you subscribing via Patreon, you will have that available very shortly. If you'd like to join Patreon, the US $50 a level, goes across to Patreon and you can sign up, and then you can get hold of the data and you can get hold of the links and things. You'll be sent a link and a password and an ID to access it. And for as long as you continue to pay the Patreon, you'll continue to get access to the data set. So that's what we've been working on. It's taken a bit longer than previously, simply because of the fact that there's been a lot to do to get it to work right. Interesting question here. This is from ADV Mark. Do you think any issues with the market in Perth? We have a rental and our agent has 15 evictions on Monday as a result of the evictions moratorium ending. Lots of properties were damaged. Yeah, absolutely. I mentioned earlier on the evictions. They are happening quite significantly. I've had more than 20 people across the country tell me that they've been evicted with minimum notice. And of course, that's because it's all coming to an end. In some cases, it's also true that some of those investment properties weren't really well looked after. Unfortunately, that is part of the problem of being a property investor, of course. Now, some of those people are looking to try and find something else to rent, and that's proving to be quite difficult at the moment because other people are putting rents up. And particularly around Perth, rents have gone up quite dramatically. So I think we're going to see some significant issues in the Perth market ahead because of that particular factor. I also am not sure that the Perth market will really perform as strongly as people are thinking it will, because remember that the peak was back in 2013 and it went down. It's going up slightly, but it's still well down from where it was. We've still got people with negative equity. And so I think there's a lot more to play for in Perth. Probably closer into Perth itself, more realistic to see prices continue to grow. Further out, up and down the coast, I still think we're going to see more trouble ahead. And in fact, I did some work the other day for a couple of my one-to-one sessions, and there was very little price growth, even for houses and units, absolutely none. Okay. Is there a place called Canberra in Australia, or have I missed it? No, it does exist. I just didn't go there because the ACT, is sort of what I included in my data. I do have data on Canberra, but it's a relatively small footprint relative to the other, so there you go. Tony says, Mortgage Stress Alley in Perth has been stuffed for years. Everything in my suburb, Mount Hawthorn's getting snapped up in around 2 weeks. Not many houses left within 10Ks CBD for under 400K. Absolutely. It is burning, close in. Not so much further out, though. Look down at Rockingham, places like that. Okay, let's have a look. What else have we got? Yogi Bear says, Tony, stop trying to buy the same property as me. That's very good. It's looking at the current economic situation from a different perspective, which we all need. Well, you know, I think that there's quite significant issues there, as we've discussed. And, you know, remember that, of course, all this quantitative easing is going on around the world. The QE is massive. The stimulus in the US, the Biden stimulus, the 1.9 trillion and the 2 trillion, is going to flow in as well. So that's all going to create some rather weird stuff, in my view. We'll see, eh? Okay, what else have we got? Just going through. Do I include underemployment in the scenarios? I do in the modelling. I don't actually report it as a separate thing, but essentially I know. In fact, when I report my financial confidence index, I do actually look at underemployment there, because underemployment is a significant factor. And of course, Roy Morgan is saying around 20% of households in Australia are currently underemployed or unemployed, 20%, right? And there is a significant correlation between underemployment and the mortgage stress. I think I may have shown that in one of my earlier shows. And there's also a significant correlation between the old JobKeeper and mortgage stress. So all of those things are correlated, unfortunately. DFA Cookie Monster says, great stuff. Thank you. Appreciate that. Okay. What else? Tristan says, nothing affordable near where I work. I'm not going to spend 4 hours a day travelling to and from work. No, that's exactly right. Affordability is a real issue. People, of course, are moving further out in some cases because they don't have to travel into work in the CBD every day. That's one of the other factors that's in play at the moment. And I think there'll be more of that. I'm in region New South Wales myself with a reasonable internet connection most of the time. And I can do quite a lot of stuff online. But the fact is that, there are people who need to get into the city more frequently. Although, of course, a lot of the statistics suggest that a lot of businesses are now not forcing people back. So we'll see. Now, Lily says, what do you think may come May, June when the zombie business start closing, bank lending slows? Will then wipe the lending laws and allow another dip to sue? But that's all quite feasible. So we know that there are a lot of small businesses who are going to struggle over the next few months. My surveys are suggesting around 20% of the 2 million are in some difficulty. Not all of them will close. Some of them will downsize. Some of them will just tip over. I think that we have to give it about 3 to 6 months to see that come through, because you've got 90 days before you start, and it'll take a bit of time to work through. They do have various things that they can do. So if things got bad again, you could see another dip into superannuation. Of course, there are some Liberal MPs who are advocating dramatically for more raiding of super. I think it's a major mistake, frankly, but it's something which people are talking about. And it's also worth highlighting that the lending laws, the responsible lending laws, of course, are actually on the books still to come back in May or perhaps June. If you want more on that, go and look at the SME Responsible Lending Misdirection post that I did, which was making the point that a lot of the government front benchers are basically arguing you need to actually remove the responsible lending obligations because it will help the small business sector when it won't. It's just a misdirection. And of course, the protections that are there currently will be removed. So I'm of the view that that should not be removed. It's also worth noting, of course, that Hayne recommended at the Royal Commission that it should not be removed, and I believe that's exactly right. So there you go. And Lily, thanks for that. Appreciate it. So the old question, of course, is always the difficult one, which is what's going to happen. It could well be that prices do continue to grind up, but I also think we've got this K thing. So I'll come back to it again. There's a proportion of the population doing really well at the moment and are feeling very wealthy and will spend like mad. There's another proportion of the population that's in the lower leg of the K that's got this compression of income, the lack of work, and frankly so many negative forces being exerted on them. And part of the question is, what's the relationship between those two proportions, right? And at the moment, my read is that there's slightly more in the upper K than the lower K, but the job keeper, job seeker removal and the other things that we've spoken about earlier on is beginning to put more weight in the lower leg of the K. So if that happens, that means that we won't get the economic bounce in terms of household spending that the Reserve Bank was expecting. If that follows through, then what it means is that there is going to be a more limited upside. Unemployment will rise. Yeah, well, we expect that to be certainly true. The question is how much it will rise. And then what happens then? And that's really part of the ongoing questions. And I don't know what the answer will quite be because, of course, there are so many variables. But it could well be that the forecasts from the Reserve Bank, again, are too optimistic. And remember, the Reserve Bank is saying no wage increase for 3 or 4 years. Inflation will stay low for 3 or 4 years. Unemployment will come down slowly. And there's a big debate, of course, whether it needs to come down below 4% or below 5% before effectively the sort of the budget repair process starts. The Treasury is saying once it gets below 5 something down into the 4s, we should start budget repair. The Reserve Bank is saying you should probably get down to the 3s before you do that. That's a big difference between those two organisations as to what the right scenario is. So I'm afraid that this is going to be a rather painful and uncomfortable journey for many people. Jason, thank you very much for that. He's bought the next round. Appreciate it. What else have we got? Other existing credit cards, I have no annual fee. They are trying to get me to take annual fees. The banks think I'm stupid. Very interesting point, Smooth Operator. There is a little bit of a thing happening where some of the services that were wrapped up free are now not free. You'll see a lot more of this, particularly if we go into negative interest rates. I was looking at what was happening in the Scandinavia, and there where they've had negative interest rates, now you pay for pretty much every element of your banking services in a decomposed manner, right? You pay for keeping money on deposit. You pay so basically everything is fee-based. So you'd expect more fees to appear in Australia as well, and there will be some cross-selling and upselling. I've had the same sort of story where people are trying to persuade me to switch from my current card to another card and pay a bigger fee, desperate to try and generate more income. Remember that the margin is for banks in Australia at the moment are artificial, because essentially what's happened is that the very cheap money from the Reserve Bank through the TFF means that effectively they can still manage a bit of margin. Effectively, the Reserve Bank is paying the profitability of the banks at the moment. That's not gone forever. They're going to need to find other revenue streams. And of course, they're hoping that the lending growth will be a revenue stream, although the margins look quite suspect at the moment. So fees, absolutely. More fees everywhere. And by the way, typical rate on a credit card hasn't dropped for many people since, well, the year dot. Remarkable but true, and a lot of people are still using credit cards. Here's an interesting question. What's the safe LVR percentage as a first home buyer? Well, there's a couple of interesting things to note. If you can put more than 20% in, you don't need to use lender's mortgage insurance, which means that you can actually get a cheaper mortgage, and lender's mortgage insurance is quite a big chunk to pay. So 80% is a good target. In other words, 20% deposit, 80% mortgage. You get the best rates also there as well. If you go higher than that, sometimes the rates will be a little higher. Sometimes you then have to take lender's mortgage insurance, which is a big fee. So that would be my sort of first take. I think you can probably assume, all things being well, it's unlikely that prices are going to dive dramatically in the short term in most areas. Could be wrong, but that's my current view. Bit of a change from where I was a few months ago, of course. But we still have people in the West with negative equity of 30%, right? So there are people who say, well, if you want to be really safe, then a 30% deposit is probably a really good thing to do. But then 30% deposit's a hell of a lot to save up for. So my own thought is that 20% hurdle is quite good. If you have to go with 20%, try and keep a 10% minimum, because that gives you a little bit of leeway. Once you get below 10%, and there are people, of course, with the government-backed scheme of 5%, it doesn't give you much wiggle room if there's a bit of movement in property prices. So that's what I'd recommend, I think. With more people going to the lower leg of the K, why aren't we seeing the property price bubble burst yet? Well, not yet. Like I said, people are just drifting there now. All of these changes came in at the end of March. The JobKeeper, job seeker, unemployment will go higher. It's going to take some months to shake through. Remember that the principal interest and payment holidays are also stopping now. So there are some people still struggling with that, still with those repayments. Give it 6 months. The reason I say 6 months is this. You don't really start measuring delinquency until people have actually missed 90 days worth. That's 3 months payments, right? Now, every time people get reset under the APRA scheme, you reset to 0, so the 90-day doesn't start. So 90 days now starts ticking from 1 April. So 3 months down the track, we will know what the 90-day situation is. Then they'll be starting to see whether there are actually foreclosures or whatever it is. That takes another few months to work through. So September is when I think we're going to see what is really happening. Maybe we should actually just question again whether things are going to actually turn up, turn down. It's going to take some time. And Otto made an interesting comment. Tell them for whom mortgage insurance is for. Good point, Otto. Lenders' mortgage insurance doesn't protect the borrowers. Lenders and mortgage insurance purely protects the bank. So basically, that 20% or whatever the LMI covers, right, means that the bank knows they're going to get that back from the insurer, but they also can still pursue you as the borrower. You are not protected in any way whatsoever by lender's mortgage insurance. It is a misnomer, in my view, and many people are under the misapprehension that they are somehow protected. You're not. You are not protected at all. So I think of all the various cons in the financial services sector, LMI will be right up there, and not least, of course, because quite often you can't get the premium back, although actually you can if you remember to ask. It's just many people don't. First point. Second point is, of course, you can lump it into the mortgage, and that's another reason why people can borrow even more. So it just means you pay it back over the life of the mortgage, which means it costs you an even bigger amount. So that's another reason why LMI is something that I think you could avoid if you can. Okay. Just moved to Darwin. Can you look at it? Thanks. Yep. Darwin's an interesting one. Prices, of course, going up there at the moment. Some mortgage stress, but not a huge amount of mortgage stress there. I might do a separate show on Darwin because I've got a few other people asking for that too. Probably haven't got time now to go into details with 916, but I'll make a note. I'd like to go around and do some of these other areas that I keep saying I'm going to. Adelaide's another one I want to come to. I'm trying to find local estate agents who are giving me a true story that I can then perhaps persuade them to come on as well. So watch this space for that. Cross Stitch Ange says, do credit scores actually matter? They sort of do, particularly these days, because of course your credit scores now have things like phone bills, electricity bills, every time you go for store credit, all of that stuff's in there. And so the banks will tend to look at the credit scores when it comes to making new loans. Doesn't necessarily drive much in the way of pricing differential at the moment. At the margin, yes. It's nowhere near as sophisticated as the US. But a lot of people, of course, don't even know they've got a credit score and never look at it. One of the things I say to people is every few months it's worth going and looking. You can run a free query from the credit ratings agencies and see what your credit score is and make sure there's nothing that's not incorrect. Sorry, nothing that's wrong there. In other words, if you've got a bad entry, it might actually be impacting your ability to get credit and what the banks may pay. So they do matter, unfortunately. And the other point I'd make is that if you effectively have never borrowed, your credit score might be quite adverse because they've got no history of it. So it's quite good to borrow a little bit on a credit card, pay it off every month religiously for a few months and build your credit score, because these days the credit scores becomes more important. Thank you very much, Mark Singleton. Find a local estate agent who will say it as it is. It's hard, you know. It's really hard. There are so many who are just spruiking all the time. It really is quite tough. But when I find them, I try to celebrate them, because there are a few who really try to do the right thing. Very glad to help. Very glad to help. Samuel says, are you hearing much about contracts crashing due to finance not being approved? Heard of 3 this week locally in Brisbane. Yes, absolutely. So one of the things that's happening is that the provisional offer of a mortgage that a bank offers, when you go and say, how much can I borrow, put some preliminary stuff together, and they give you a conditional offer, isn't firm and binding. And quite often, when you actually go and say, right, and now I've got this property, they might well turn around and say, oh, actually, we're not going to give you the loan you thought, because the valuation has come in significantly lower than was expected. And valuations are still dropping in a number of areas. I was talking to a valuer today, actually, on just this point. So in other words, what they thought was going to be the value isn't the value, it's lower. And so valuers come in lower, and that means they aren't prepared to lend as much. That means you suddenly get left with okay, how am I going to find that $50,000 that I need to be able to sell to close the property deal? Do you knock on the bank of mum and dad? That's been done a few times this week. Do you try and find another lender, maybe one of the non-bank lenders who may lend you more for a bigger rate? Or do you walk away? And there are some examples where people have had to walk away. Of course, if you've exchanged your 10% deposit, you lose that, at risk of losing it at least. So that's a big deal. One of the things I would just mention there, which is something which I've had a few people ask me about, is deposit bonds, because deposit bonds might actually be another way of dealing with that issue. Deposit bonds means you don't have to find your 10% on day one. What you basically do is get a deposit bond, which basically makes it right for you to be able to actually go to the 10%. You're still legally obliged to go through with the transaction, but it's quite a lot easier. I made a video on it a few weeks ago, which might be worth looking at if you're interested in that. I do think it's worth exploring it in a little more detail. Not saying it's perfect for everybody, but there are times when deposit bond works quite well, so just maybe worth thinking about. Thank you very much. Really appreciate the contribution, and I'm just telling it as it is. That's all. I'm just trying to tell it straight. Interesting from Telly there, the real estate agent I bought my house off has recently closed its doors. Well, I'll tell you something. There are a lot of real estate agents who were on JobKeeper, and of course JobKeeper stopped. The volumes of transactions that are being sold at the moment are very low, so quite a few are struggling. And when they're struggling with low volumes, it doesn't work. And so therefore we're seeing more closures. So I expect to see more of them ahead, actually. Interesting question from AJV. Do we know how many were paying off mortgages with JobKeeper? Yeah, a considerable portion, actually. So in my data, I've got that data set, so I know what proportion. As I said to you earlier on, there's quite a long, high correlation between the high stress levels and the JobKeeper. So a lot of people were actually relying on JobKeeper, I fear. Now, this is a very important post from Cross Stitch Ange. How's the dogs going? It's one of my dog's 6th birthday today. Happy birthday to Angus. Very good, Angus. Yeah, well, Meteor and Luna are doing okay. They're our Kelpies. They've taken to barking at motorbikes at the moment. Every time a motorbike drives past, they bark at them. It's very embarrassing. And buses. So they are quite hard to control, but we're getting there slowly. So. Thank you for asking that. Luke, thanks for that. Appreciate that. Well, I'm just trying to share my insights and hoping that people can learn a little bit. One of the things I think is really important to stress is that the thing about this stuff is that there's a lot of rubbish being spoken. There's a lot of jargon being used, but it's worth trying to peel it back and trying to understand what's really going on. Because actually, at the bottom of it's really much more straightforward than people perhaps would want you to believe. Cookie Boy says, I'm interested to see the real unemployment rate from Roy Morgan in the next few months. It will be, yeah, absolutely. I mean, they've got a different way of calculating it relative to the ABS. That's always higher. I personally think it's a more accurate measure. The ABS measure basically says if you work hour a week, you're employed. Pretty concerning. So underemployment and unemployment is pretty important. Oops. Is blue gold ethical? I don't understand the question. Sorry, you have to rephrase that one. Do you expect real estate agencies to fall over? Do you think more fraud may occur as a result of their difficult times? Yeah, well, they're already in some fraud. So things like, for example, persuading people to go to auction and charging for the campaign fees. That's one of the things that people do. Another one is that there's a little bit of a thing where you basically all have to put your bids in and send in your 10% deposit, and one person may or may not get the property, right, from a cash flow perspective. We've also got the situation where underquoting is still very rife, and that tries to get more people to come along on the principle that you get the psychology then of bidding for the auction, and then prices go up, and of course if the prices go up, they make a bigger commission. So. Cross-stitch Ange, another one says, do you have data on those ahead? Yes, I do. I've got data. So when I ask my surveys, 52,000 households, one of the questions we ask is, are you ahead? How far are you ahead? Both in dollar terms and in terms of how many months. If you're interested, I might make a presentation on that. It's quite interesting because there's some really interesting distributions across the country and across postcodes as to people who are ahead with their mortgages. And it's not necessarily those that you might think would be. So perhaps we'll be talking about that at some point. And this is one from Blurred Squid that says, will RBA hike rates once the Fed is forced to do Operation Twist? Possibly, yeah. I mean, we don't know what the Fed's going to be doing. We know there's going to be more liquidity. We know that they're going to be trying to control the longer end by the shorter end. That could all have an impact. The RBA is claiming they're not going to move rates up for 3 years. They'll find it more difficult, I think, hence my earlier conversation earlier on. Cook is saying, can you persuade Tarek to do a live show? He's not up for it. I've tried. He's happy to do a recording. We're doing one on Friday, but doesn't want to come on live, so there you go. Chris B says, do you expect the banks to raise rates on pressure of the international markets? Yes, I do. So effectively, it's quite clear to me that the rates pressures will come from the international markets and from the yield curve rather than from the Reserve Bank. Pablo asks, do you see a bigger risk in the US or Australia? If US crashes, does Australia have any chance? No, Australia won't have any chance. Whatever happens in the US, we are an outlier. We are just a little cork on the ocean. So one of the reasons why the Reserve Bank is having to do what it's doing is because of what the Fed is doing in the US. The Fed will do more QE. They've quite clearly said they're going to do more QE. That means that we're going to have to follow suit. If the US crashes, which is certainly still on the cards, depending on what happens, then we are definitely caught. And going back to my scenarios, the scenario of significant falls in prices is partly driven by that international crisis. Cross-stitch says, yes, interested in how many people are ahead, thinking it's best to invest my spare change at the moment rather than putting it in my low-rate mortgage. Yeah, good point. With rates so low, it's sometimes worth just paying the mortgage at the standard rate rather than paying down. But, not financial advice. There are other options. The risks, of course, think about risks, because investing in almost all asset classes at the moment are very risky. That's true of gold, silver, as well as the stock market, as well as bonds. Interesting question from 123 Logic. Is it worth real estate's time dealing with rentals? It seems that many aren't interested in the work. That's true as well. Doing rental management properly these days with the significantly enhanced regulations is tough. I did a show some time ago when we talked about some of the things that they have to do now. And of course also they've got issues with the strata management and all of those questions as well. So it's a very complicated and time-consuming thing. Many of the real estate agents don't do it properly. They cut corners left, right and centre, and that could lead to significant issues ahead. So it's quite clear to me that that's not where a lot of the money is to be made. And it's interesting that if you talk to estate agents from a few years ago, they would have a smaller number of properties and more time to focus on them. These days, they tend to have a larger portfolio of properties, less time to focus on them, bounce from issue to issue to issue, and as a result of that, nobody gets good service. Smooth Operator makes the point we didn't crash in 2008 when the US fell 52%. That's because of China. Simply because of the massive stimulus that China gave to their economy, and that then protected us. We also got bailed out by the Fed, several of the banks did, and as a result of that, we actually sailed through. It wasn't really just good planning here in Australia, it was because of China, because of the Fed. Okay, Cookie Boy says 407 on board, epic stuff. Well, thank you for that. Yeah, and please like the post, guys. Please like the post. It's really important to get the things going on YouTube the right way. The US is crashing now. I think they're in denial. Well, they're trying very hard to stop it crashing, all the stimulus packages, but the question is, will it? And the answer is, they won't. I had a tree growing in my gutting for 2 years. They won't clean the gutters. It says muzzle flesh. Well, yeah, tell you something. The standard of maintenance on many rental properties is disgusting. And in fact, an ex-rental, if you're thinking of buying an ex-rental, get it surveyed because there's so many things wrong quite often. Tristan says property management is expensive because of the last mile issues and extremely time consuming. Spot on, exactly right. It is. It's not an easy business, particularly now, particularly with larger numbers serviced by small numbers of people. Daniel says, have you looked chance to look at Perth's interest in how the housing market split is materialising amidst the high rental demand? It is, absolutely it is. And it will continue, absolutely will continue. We are seeing two very significantly different markets there. Okay, well, I'm pretty much done. I'm just going to go back to my presentation. Second, go back to there. Let's go that. And I'll just picking up my earlier conversation. Remember I mentioned deposit bonds? I will just highlight this. That show that I mentioned is called My Name is Bond, Deposit Bond. If you've not seen it, it's worth just looking it up because it is actually a really useful little tool, I think, that some people don't seem to know about. And by the way, many agents don't know about it either, but it's quite a neat little trick. So there's a show on it. Now, in terms of other things to talk about briefly, I will just make this point. If you want to know more about what we're up to and the World Fund and World Super, go over to world.com.au. That's where a lot of information lives. That's my collaboration with Nucleus Wealth, of course. We also have the blog, which contains a lot of information. You can sign up there and get all the notifications from everything that I do, all the posts, and a lot of other information too. And that's separate from the membership panel that I mentioned earlier on, which is just coming to fruition now. You can also go to Patreon, and if you sign up on Patreon, you can basically contribute at various levels there, from more DFA, which is sort of $3 US, up to $50 US a month to get the stress data. At the $50 a month level, you actually get the full stress series across the country, and also access to the new portal that I showed you earlier on. Also, still doing the one-to-ones. That's when you can have an individual conversation with me about property, down to a suburb level, booking about 3 to 5 weeks out at the moment. There is a cost involved, but if you are interested, reach for me by the DFA blog. You can also contribute via PayPal. There's my link there, or indeed by Bitcoin. There's a Q code there. People are doing that. Really appreciate that. And there's a merch available if you want to support us that way as well. Next month, Chris Bates is on talking about Sydney property. Very relevant given everything that's going on. And the fact of the matter is that there's a lot to talk about with regards to Sydney property. So Chris Bates will be coming on. It'll be a fun show. And I look forward very much to seeing what he has to say, and specifically this question about the difference between sort of units and apartments and in and out of town and those sorts of things. So I'm just going to put this up. Thank you very much, Jason. Appreciate that. Thank you so much. Cross Ching likes the the title for the Bond show. Yeah, I was quite pleased with that. It was what I sort of suddenly came to. Very good. James says, don't worry, Nancy Pelosi's in charge. Well, she certainly could well be, although I think Yellen is also doing a few things too now, particularly with the US income, the US corporate tax rates. And Chris says, thanks very much. Donna says, thanks very much, good night. And we're pretty much there. Thank you very much for spending your evening with us tonight. Hope we covered a few things. And I'll look forward to seeing you this time next week with Chris Bates. Thank you very much for all the comments, all the questions. Sorry I didn't get to all of them. There's always another time next time. If you want data on a particular postcode, just send me a message via the DFA blog and I'll send you back the one postcode set of information. And very much appreciate other people appreciating all of the time. Don't trust the Biden. Yeah, I suspect you could well be right. We'll see. Andrew says thanks. Luke says thanks. And there we go. Paul says cheers. Thank you very much. Jason says, yep, look after yourselves. See you next one. Off to bed, everyone. Indeed. Yeah, exactly right. And a smooth operator says, yet another 100-year-old in the US Fed. Oh dear, it is a bit like that. Cheers, guys. Thank you very much. Appreciate your time tonight. And we will see you all again next week. This is Martin North from Digital Finance Analytics, signing off.